Welcome back to the On the Money YouTube channel powered by Allied Wealth. I'm your host, Ryan Wheelis, and today we're going to spend some time talking about myths and facts about investing. Lots of them out there, by the way, folks. Let's jump in with the first one here. Is investor behavior affecting performance? So does your behavior in times of market volatility, does it impact the performance of your accounts? And folks, scientifically proven, the answer is absolutely yes. There's a study done every single year, and going back 25 years. This is the 2015 edition. They're still doing the study today, and it's called the Dalbar study. And what the Dalbar study looks at is what is the average annual return of the stock market over a period of time, for instance, this 20-year period here, versus what you, the average investor, actually earn in your accounts. So 8.19 over this 20-year period versus 4.67 in this 20-year period, the actual mutual fund investor received in their accounts. And that's a gap of 3.52%. And what we find, folks, is that a lot of this has to do with behavior. We tend to get very emotional in times of market volatility, especially considering that we may be retired, and depending upon our nest egg to produce the income, we need to finance our lifestyle. Or someone who's maybe 5 years in retirement may be very emotional, or 5 years in the red zone, or 5 years from retirement may be very emotional as a result. So there's a lot of reasons why we make bad decisions because of emotions. And it's never wise to make decisions from an emotional standpoint, an emotional state of mind, proven by this delta right here. So what tends to happen is we see stock market volatility, we see our portfolio falling in value, and we go, man, let's jump ship. Let's get out of the markets and go into treasury bonds, for instance, or CDs, or whatever it might be. And what happens is if you do that, you risk locking in a loss and moving into a position that won't earn the upside potential that the market would. You may not recover that loss. And then you compound that with distribution of your portfolio. You can really be in a bad situation in a hurry. So you've got to really manage behavior. It's something to be mindful of and cognitive of. And one thing that you can do to help you manage behavior is don't look at your statements as your financial plan or your retirement plan. There's more to it than that. Have something that looks at what you have, what your income needs are, all right, and your risk tolerance and risk capacity, and calculate all those things together to get to what we call a long-term probability of success. And we're trying to get that long-term probability of success up around 85 or 90%. And what happens, though, is when we have a negative year, what I want to do is, instead of looking at the accounts that you've got and the losses that your accounts may have suffered, what I want to do is I want to look at that long-term probability of success. Are we still above 85%? Did we go from 90 to 98, or from 90 down to 89 or 87 or 86? Did we go from 85 to 84 or 83? What did we do there, right? That's super helpful, because if your probability of success drops from 87% down to 85%, you're still going to be okay. May not feel good in that moment, but you're still going to be okay. So super important to just be cognitive of behavior really affecting your long-term investment performance, and not making decisions from emotion, all right? Now, compounding this are these guys. And this is it's out of hand, folks. I mean, the media, especially if you watch CNBC, which I do often, but it's so instantaneous, and the news is so quick paced. It's like it almost makes you feel like you're a day trader or something. I mean, for instance, the Dow Jones had its worst day since yesterday. The stock market's on track for the worst week since 2009. The S&P's down over 12%, the worst day the worst downturn in market history since yesterday. It's like all these headlines that are really designed to spook you and scare you. And it's just instantaneous barragement of negativity in a lot of cases. And it can really, if you listen to it, it can really cause you to become very short-minded and short-thinking. And folks, I got news for you. When you get to retirement, you have not reached the finish line. You're nowhere near it. You've got to live the next 30 to 40 years without a paycheck and not run out of money and income in the process, and managing your behavior, and also being mindful of what these people say on the news, and also understanding the fact that you are, in fact, a long-term investor, all right? So you've got to keep those things in mind to help you manage that behavior in up and down markets. This one right here is another example. This is this was a CNBC Market Turmoil special report. And then this is right around 2000, late 2015, 2016. And then Donald Trump, back when he had his Twitter account, made a negative tweet. And the point of this slide, as you can see, the market was down here pretty good right there because the market got doubly impacted by bad news. And folks, the news travels so fast and the market is so efficient at pricing things in. That's why when we see some news like this come out, that it'll dip like that. But understand, there's going to be short-term fluctuations. But if you look at this, the lower left corner of the slide here to the upper right is still an upward trend, right? So we are in a trend. If you go back and look at Ridex used to put this chart out from like 1928 all the way to present day, and the trend is lower left to upper right. That's the way it works, okay? And it will continue to work that way, though we may experience some periods of short-term volatility. So don't panic, don't sell. Go back and look at how that volatility and those losses in your account are impacting your long-term probability of success number. And if it's not messing with it too much, don't worry about it, all right? Maybe dial back your spending that year a little bit until the market comes back. But other than that, don't get too excited about it, and please don't panic. It's the worst thing you can absolutely do. This one's good too, the influence of family and friends, right? It's one of these things where you want to listen to people that you love because you trust them and you know them, and people, like they do business and they care about people they know, like, and trust, right? So it's, families is kind of the same way. And so I hear this, my neighbor told me you should be buying gold. Well, sure, you should be buying some gold. There's nothing wrong with that at all, right? Or the guy at the water cooler says I should be doing this or this or that. The thing about it, though, is every person is so unique. They have their own thumbprint. Their financial identity has its own thumbprint, and everybody's uniquely different. And so you really have to look at what you are comfortable with versus what your neighbor Bubba might be comfortable with, right? Or Bubba might say, hey, don't buy annuities. Annuities are bad. Or Bubba says, hey, buy mutual funds and just buy the stock market and ride it out. Well, I always ask, has Bubba shown you his portfolio, right? Or I've got another client whose brother trades options and E-mini futures. And I'm like, well, I don't do that here at Allied Wealth, but if you want to do that, you can. The challenge is your brother's got $4 million. If he loses half of his money with his aggressive strategies, he's still got $2 million. Miss Jones, you've got $800,000. You can't afford to lose half your money because you won't be able to maintain your lifestyle in retirement. So you got to look really bigger picture at your own situation and make your own decisions and try to be cognizant and mindful of outside influences, all right? And always ask them, hey, if you're recommending this to me, show me why you're doing this and show me that you're doing this, because they should be doing it too, all right? Next thing, emotions. We already kind of talked about this. We see it all the time. When markets go up, investors, they want to be more aggressive. Like, hey man, the stock market is really cranking here. Let's juice the portfolio, so to speak, and try to get that upside. I actually had a client do this last year at the exact wrong time. I said, don't do it. Don't do this. Not a good move. He did it. Went up initially, and the market went right back down. He lost about 20% of his money last year in that strategy. So be careful of that. And then to the other end, when the markets go down, investors want to be more conservative. And that's just the way it works, folks. I don't know why it is. So we want to be more aggressive when the markets are up and more conservative when the market's going down. Well, we should flip-flop that. As the market's going higher and higher and higher, we should be getting more and more conservative and taking some of those gains out of the market and putting them in some more safe vehicles, right? And then when the markets are down, we should be coming out of those safe vehicles and buying into the markets again. But our emotion allows us to think the exact opposite. So be mindful of emotions as well. I love this one, conventional financial wisdom. Conventional financial wisdom was born in a time period from 1980 to the year 2000 when the stock market returned over a 1,000% return. The only time in history that's ever happened, by the way, folks. And that was largely because the 401k plan was added to the Internal Revenue Code. And when that happened, people started putting tons and tons of money into the stock market via their 401k contributions, the company matches, all right? So you had this massive melt up. But nonetheless, you hear this buy and hold is the best strategy for retirement accounts. Hey, when you're going up the mountain to get to retirement, buy and hold can actually work really, really well. The challenge of buy and hold, though, when you do retire, is if you're buying and holding and the market's starting to fall and you're taking income out of your portfolio, you're dollar cost averaging in reverse. One of the best ways to build a long-term portfolio for retirement is to dollar cost average. one of the quickest ways to destroy a good portfolio in retirement is to dollar cost average in reverse. So be mindful of that. Diversification will protect you. Not really, because last year in 2022, there was no place to hide but cash. The only asset class that was up were commodities, but even they came back down some too. So you can't be in a situation to reallocate all your capital to just commodities, because the drawdown in commodities can be anywhere from 40 to 50% if you make the wrong move, right? So that's being too aggressive. There are ways to use diversification to protect you, and I believe that's balancing the amount of money you have in a risk position with the amount of money you have in a safe, can't lose position. That's the way to use diversification to your advantage. Stay invested. We've got another slide on this here in just a minute. You can't miss the best days. I've heard that, and that is true. You can't miss the best days of the market. If you do, you often get way less the return. That's true, all right? But it's also one of these things where, you got to give me some more time, right? Or don't be a fool who sells the bottom. Do not move to cash. The rebound is equal to the drop. It's okay to lose money, it'll come back. These are just paper losses. This is all sales jargon, folks, that really the mutual fund industry was taught, the people that sell this stuff, was taught to keep you invested and keep you on the hamster wheel going round and round and round. So a couple things I'll say is, if you want to jump out of the market at the bottom, that's a bad move, right? And we don't know when the bottom is. So that's why I'm a big fan of having risk money and safe money, all right? Next thing is the rebound is equal to the drop. I don't know, maybe sometimes the rebound is way more than the drop, right? Like we're doing right now. This one is funny though too, is it's okay to lose money, it will come back. I'm sorry folks, but the money you lost ain't coming back. It never gets back, all right? Further, if you're taking money out of your portfolio, you're in a situation to where you're compounding your losses. One thing about this too is if you go back and look at 2007 and 8, when the market was down, the bottom of the market I think was around March 9th, 2009, and then when we got back to where we were in 2007 was about 6 years, all right, maybe 5-6 years. The thing about that is 5 or 6 years of your life gone in retirement can be a big deal, all right, because I believe as we get further down the road with age, that the time we have left on this earth is more valuable than the money we have left, all right? So, it's okay to lose money, it'll come back. You might, all right? But you will never get the time it takes to come back, all right? These are just paper losses. Well, but I got news for you. If I am living on these dollars and my account's at $1 million and I'm taking just say a 5% distribution out of my account, and my account goes down from $1 million down to $500,000, all right, my income just went from 5% of $1 million or $50,000 down to 5% of $500,000, which is $25,000. I just lost half my income. That is not a paper loss. That is a real loss of income, and that can be very detrimental to your long-term success of staying retired and being happy in retirement, right? Next thing here is sales jargon. This is stay invested. You can't miss the best days. Well, we did some math, all right? And this is actually this is a typo here. It's from 89 to 2015. But during that period, the S&P 500 returned 8.51%, all right, abouts. If you missed the best days of the stock market during this period, your return was around 3.64%. If you missed the worst days, your return was 14.82%. Now, this is getting into the buy and hold, right? So if you bought and held, you got both the worst days and the best days, right? So the point is there are other ways to do it by utilizing different money management techniques and strategies like balancing risk money and safe money to where you can actually miss both the worst days and the best days. Now, I'm not saying I've got some strategy here that just times the markets perfectly. It doesn't work like that. But what I am saying is there are strategies out there available to you that will help you achieve a more consistent return over time. Don't believe me? Go look at endowment funds, folks. Endowment funds focus on achieving a steady, consistent return over time instead of trying to ride the ups and downs of the stock market, which is why they're wildly successful with the return numbers, by the way, all right? So, love this one, by the way. This is a conventional financial wisdom test here. It's okay if you lose money, it'll come back, right? Well, I mean, here's the way it works. If you lose 50% of your money, it takes a 100% return to get back to even, all right? So the interesting thing about that is if I have $100 and you lose 50, you've got $50 left. Well, if you add 50% back, all right, then you've got $75. So you went from $100 down to $75, yet your average return is 0%, right? You're down $25 and your average return is 0%. So be careful of average return too, folks, because losses are very hard to make up, all right? Especially when you're pulling income out of your portfolio. And if you're in a situation to where you're looking at an average, a lot of downside risk can be in that average return. And that downside risk may not be something you can stomach in a very, very bad market situation when you're dependent upon the assets you have to produce the income you need to finance your lifestyle in your golden years. Next thing is return is the most important factor in my portfolio. Well, it's not, folks. There is something way more important than return, and that was called standard deviation, all right? So what is standard deviation and what does it mean? Well, basically, if we look at this portfolio here, it's got a 7% average annual return. And it has a standard deviation of 13, okay? And how I know that is this. 7, one standard deviation out this way to 20. 7 plus what equals 20, and the number is 13. So 7 plus 13 equals 20. And then if I take 7% or 7% minus down to 6%, that's a minus 13% return, right? So we can see here that our standard deviation is 13. Well, what that means is if the return average is 7%, you might have a year where things just really take off and you might get up to a 20% return in this portfolio. Cool, nothing wrong with that. However, there is a downside to it. The reason why I say that is the market will very rarely move more than one standard deviation to the upside in an up market. However, in a down market, it often moves 3 standard deviations down. So what that could mean is you have 7% here, so this is 13% standard deviation this way, another 13% standard deviation going out here, and then one more 13% standard deviation. So you could have 3 standard deviations to the downside in this portfolio, right? So what is that? That's minus 6 plus minus 13 is minus 19, minus 29, minus 32%. So this portfolio might make 20% in a really good year, but it could also lose 32% in a really, really bad year to get an average annual return of 7%. Folks, this is something that's super important to understand and know about, and any mutual fund that you're looking at out there, by the way, or ETF or portfolio will always have a standard deviation. Look closely at it. What you want is a standard deviation to be lower than your average annual return in your portfolio. That's a good indicator that that portfolio or that mutual fund or that ETF has a very good risk-adjusted return and should be able to achieve that steady, consistent return over time that we're actually looking for, all right? Last one here under myths and facts is what we call the old Ryan, I'm paying you to manage my money, and the market's up 15%, and my portfolio is only up 9%. Well, I'm paying you to manage money here, Ryan. You're not able to beat the market. You're not able to keep up with the market. What's going on? All right. And this is a super important one to understand. And the reason why it's so important, folks, is this. You got to look at the portfolio and its makeup, and you got to understand what to compare the portfolio to. So what I mean by this is we have a risk versus return curve here, okay? And on this risk return curve, going this way we get more aggressive, and going this way we get more conservative. So this portfolio here is the most conservative portfolio, and it's made up of 100% bonds, all right? And as we go out here to add more risk to the portfolio, we add stocks to the portfolio, okay? Or to go back this way, we take stocks out of the portfolio and start adding bonds in to make it more conservative. Well, to that end, we have to look at, okay, let's say that we're in this portfolio right here, all right? And we're saying, okay, the market's up 15%, and I'm only up 9%. Well, the missing pieces are a couple things here in this analogy. You got to look at the bond market return. So let's arbitrarily say that the bond market return is 5%. Well, if you're in a 60% bond portfolio and 40% stock portfolio, here's what you have to understand. 60% of your return is going to come from the bond market, not the stock market, because your portfolio is not allocated to that much in stocks, all right? It's only got 40% stocks. So you'll watch the news and go, well, Ryan, the market's up 15% last year, and I just don't understand why I'm only up 9%, okay? Because on the news, folks, they don't talk a lot about the bond market. In fact, when you see a positive number on the bond market, it means rates went up. It actually means bonds went down that day. So it's actually not a good day for bonds, by the way, all right? But they don't talk to us about this stuff on the TV. They just report it that way. So super important to understand here is let's do some math, okay? So if we've got a portfolio that's 40% stocks and 60% bonds, and we're going, hey, the market's up 15, you only did 9, what's going on? Well, let's look at it. So if you weight the portfolio return of 15% from the stock markets, we got 15% return from what the market did, all right? We only have 40% of our portfolio allocated to the stock market though. So we take 15% times the 40% weighting, and that equals 6% of our portfolio return should have come from the stock market. Well, we know right here that the bond market did 5%, and 60% of our portfolio is made up of bonds. So we take 60% times 5%, right, and get a weighted return of 3% for a total return of 9%. Well, based on what our risk numbers are and where we are on this risk curve, we're not way out here on the risk curve. So we have no business comparing our portfolio to this number up here, what the stock market actually did, because we're not taking that much risk in our portfolio. And folks, this is called understanding your benchmark and understanding how to properly compare your portfolio to what you're seeing on the news so that you don't ultimately make a mistake and say, you know what, these guys are terrible. The market did 15, I only did 9. Well, this is exactly what you should have done had you been in this portfolio right here. Well, folks, I'm Ryan Wheelis. Thanks so much for watching the video today. If you like the content we're putting out, give us a like down below. Hit the subscribe button. Feel free to comment as well. I personally answer all the comments. And I hope you added some value to your day by watching this awesome video. We'll see you next time right back here on the On the Money YouTube channel, powered by Allied Wealth.